One of my next guests agrees recession is back in play. The other sees stagflation as the bigger concern. Joining me now, Mark Zandi, chief economist at Moody's Analytics, and Steve Odland is CEO of the Conference Board and a CNBC contributor. I mean, neither one of you sound all that optimistic about our prospects here, but let's break this down a little bit. Steve, let me begin with you, if you don't mind, to just walk us through some of these numbers from your report this morning. And your report has typically been a little bit more positive than the consumer sentiment read, and this month, not so much.
Yeah, the Conference Board's Consumer Confidence Index came down a lot, but it was driven by the Expectations Index. So this is what consumers are saying they think is going to happen over the next 6 months. They feel okay about today, but they're really worried about what's going to happen. They're looking at interest rates, they're looking at tariffs, they're looking at the stock market, all the gyrations there, and they're looking at interest rates, which aren't coming down. Given that, a huge portion of our GDP is driven by the consumer, we're worried about it. And the Conference Board has taken the GDP forecasts down for 2025 to 2% growth, and we've taken inflation up to 2.6%. So we don't see a recession on the horizon, but we do see a risk that this growth keeps coming down and inflation still stays high, which, of course, is that really nasty S word, stagflation. We're not projecting it, but that's what we're watching.
Well, in part, that's because of what consumers are saying about inflation as well. Is that right? Did you guys also get a reading around 5%?
Yeah. So it depends. Okay, so consumers are maxed out on their debt here, and they're really worried about where that's going to go. Because if interest rates remain high, mortgage rates remain high, credit card rates remain high, you really don't have a lot of maneuvering. You've got the vast majority of consumers who are living paycheck to paycheck, and so it's a cash economy in their mind at the moment. So this is what's putting a damper, we think, on growth.
All right. So, Mark, and again, that's why, the stagflation recipe comes from that slowdown that you're picking up on, maybe sticky inflation or bond yields that we're looking at. Mark, you're a little bit more in kind of the classic recession camp for later this year. Is that right?
Well, I want to restate the case, Kelly. I mean, I think odds are that the economy is going to navigate through without going into recession. But I think recession risks are high and the odds of a recession are rising. And Steve might enjoy this. I think my favorite leading indicator of recession is his Conference Board survey. Historically, if that falls, the overall index falls by more than 20 points in a 3-month period, consumers are packing it in, and we go into recession roughly 6 months later. Well, if you do the arithmetic, given this month's decline, we're down 17 points. And over the past 4 months, we're down just about 20 points. So we're, kind of sort of there. And I think if anything else comes along to push consumer confidence down any further, I think they're going to pack it in. Kelly, at the end of the day, a recession is a loss of economic faith. Consumers lose faith that they're going to hold on to their jobs and they stop spending. Businesses lose faith that they're going to be able to sell what they produce. They start cutting it. You get into this kind of self-reinforcing cycle. So confidence, sentiment really does matter. And I think we're right on the edge here. So I think it's really critical for economic policy to shift gears here pretty quickly. Otherwise, recession risks will continue to rise and become more likely than not.
Well, that's what I was going to kind of ask you. And I assume when you say for policy to shift gears, you're talking about the White House. Have we been through periods like this where we can get a confidence shock for whatever reason? And if the event or the feared event passes without much incident, that it bounces back?
This is unprecedented. I mean, confidence obviously has fallen in the past, but for, obvious reasons, pandemic, 9/11, a global financial crisis, Y2K bubble burst. I mean, that you can pinpoint events. This is self-inflicted. This is policy. This is global trade war. This is DOGE cuts to jobs and government funding. This is a very aggressive immigration policy. And I suspect one reason you mentioned the 10-year Treasury yield is still elevated is because the next thing that's coming here that's going to add a lot of uncertainty is the Treasury debt limit. As you know, that clock is ticking. The Treasury is going to run out of cash by my calculation in late July and early August. Congress has to do something, and that's going to be a lot of drama here. So, confidence is key. And, if the economic policy doesn't start to shift here pretty quickly, I think it's going to go south. And again, recession risks will continue to rise.